Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today was September 13th, 2023, and this was Blockhead Traders Weekly, but we had a little bit of a snafu this week in recording. So most of this episode was actually recorded on September 13th. However, a significant chunk of the audio was lost during the recording. So this was going to be an update episode, updating you on 3 of recent experiments that we have been embarked on with Viper and myself. The first being U.S. Treasuries, which is something I had dabbled in. However, that audio was largely lost during the recording. The next topic was our decentralized crypto exchange bot trading. Also, a significant chunk of that audio was lost. There was enough audio, however, from the Bitcoin challenge update. So that is the only thing that will be covered in this week's episode. I will be re-recording pieces of the first 2 topics to give an appropriate update in the future. However, before we hop to this week's loan content, I want to give a shout out to our Discord, link in the description below. You can click in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You can also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up wherever you get your podcast, and if you can't find it there, let us know and we will get it there. But hopping to this week's content, like I mentioned, we lost a lot of the audio for the first 2 topics. There is enough audio here of the topic of the Bitcoin challenge that Viper had embarked on. And this is where we had 3 different options that he was investing. I'll put a link in the episode above where you can go back and refresh this experiment. But this was when we were talking about spot ETFs and the advent of them potentially coming on the market, as there is none available to this day within the United States to have a spot Bitcoin ETF. There are ETFs on futures. There are leveraged ETFs, but there is not a spot Bitcoin ETF available. And so we are going to hop to Viper's commentary here, and he is going to fill us in on where the experiment lies as he's just getting ready to wrap up. It's been about 2 months. So Viper, what's going on?
So yeah, at the very high level, this was inspired by the fact that we don't have a spot ETF, but we do have a leveraged futures ETF that's available on the stock market. I think there's a couple of them, but at this particular time, one had recently launched, I believe. And so I was like, hey, let's, I don't even know. I mean, I guess the experiment was, let's compare. First of all, this is a managed ETF. So let's compare their performance with the spot underlying, because again, that's important when you get into any ETF, figuring out how it's managed, where its fees are, and all that sort of thing. And so this was just an attempt to just very crudely, non-scientifically track their performance. Though I will caveat, they very clearly lay out in the prospectus that they are only guaranteeing the 2x leverage performance on a day-to-day basis, not over a longer span of time like we're about to do. And then the third option was, well, let's tie in some DeFi here. And I found an interesting new DeFi protocol that I was checking out. And so I, took the same, it was $100 position in all 3 cases, took that $100, threw it into this DeFi protocol as well. And then let's see how it pans out. And, if we take a look first here at, just the spot Bitcoin buy. So the buy was, here at about 30,400 and some change. It was actually just before we had this nice spike up here, because within the first couple days I'd texted Sprocket and I was like, hey, check that out. What a good entry. No, and down we went and down we go. And again, this Again, I think the experiment was largely off the rails. It wasn't a clear plan. Well, the plan, I guess, was just to hold it and see what happens after 2 months. And the 2 months was chosen because that was the lockup of the vault of the third option. But nonetheless, if we're checking out performance here, so we got in here, and today we're down here, which is about a loss of, say, 13.8% here, that the price is down on that spot position. And so if we take a look now over at the leveraged futures, now this is BITX, and this is what is listed on the stock market. And it is obviously down very similarly, as you would expect, because it represents Bitcoin. But based on, this 13%, if we were unfairly holding them to the standard of did they maintain a 2x leverage from where I entered to where we are today. Again, I say that's unfair because they only promise that day to day. But nonetheless, if we look, this position is down 31%, which honestly isn't too terribly far off the mark. 26-ish per. Yeah, because imagine if it went the other way. That's bonus. So, but it's in the ballpark. 26% would be the true-ish 2x leverage. So, I mean, performance-wise, that's actually not too terrible. It was just, the performance of the underlying was the real issue here. So, if I were to draw a conclusion from this, I would say if you're crypto averse but crypto curious, like crypto averse is in like just not wanting to touch any exchange, Coinbase, any, crypto exchange, this isn't a terrible vehicle to get into it. That is absolutely not a recommendation or financial advice or anything like that. But it is to say that the value of this does tend to track what the underlying, aka Bitcoin, is doing. However, you should be aware of the 2x leverage part because, like you can see here, the spot buy was down 13%. This is down 31%. So if you had $1,000 that you wanted to put into this, and it was $1,000 of just buying Bitcoin straight or $1,000 of buying BitX, that is not an equivalent trade right there. You should very much get in the mentality of this is 2x leverage. So to put at risk for your risk mitigation strategy, which I know you do because we talk about it all the time, right? Then you should probably consider I have $1,000 to put down if I wanted to go straight at Bitcoin, or maybe $500 that I would put down to go straight at BitX here. I think that's a pretty healthy takeaway. But certainly, again, DYOR and all that other stuff about doing your own research and coming to your own financial conclusions. Yeah, and I think I'm coming to the conclusion myself that it's much healthier, and I think it's a decent argument when you approach leverage purely not as, oh, I could get more money, purely from a capital efficiency standpoint. So again, in that example, I have $1,000. If I acknowledge the leverage, acknowledge the performance, and then I go, hey, I still have the same risk requirements, so I'm going to put that $500 into BitX. Now I have $500 cash, which I could do something else with, which I could just let sit in cash. And, now all of a sudden, we're just better balanced. You put that $500 into a treasury bond, things like that can help maximize your cash efficiency. Because if we've learned anything on this journey, it's that cash efficiency is king, capital efficiency is king. But that comes at a risk in the case of this leverage here. If you're not aware of those mechanics, it can really hit you hard. In this exact case, you'd be down $360 versus being down $180 or, that sort of thing. Yeah. And not to mention, like, this is heavily managed. We looked into the prospectus last time. Heavily managed. So who's watching the watcher? Who's monitoring their management of this? You sign this 150-page I agree to not hold you responsible, yada yada. Like, yeah. So there is plenty of interesting takeaways, I guess we'd say. All right. So the third option, again, I guess we're not going to focus on the name or anything like that, especially because now that we're going, real deep into the weeds here, don't ever look at anything that I'm in that we're talking about as a sign of approval or something that's safe, but definitely so that's the clear, hard hats are on. We're going into the mines. So without really focusing on the name of the protocol per se, the whole idea here is that over here they have these liquidity vaults. And so it's a pairing, liquidity vault being a pairing of two particular assets. And in this one, you have a USDC paired with USDC. You have a Bitcoin paired with USDC. You have a Bitcoin paired with Ethereum, and then a Bitcoin paired with Bitcoin. We can absolutely, maybe on a future episode, if there's interest, dig into why you would do that, why you would pair these different things. But the point is, there's two assets being paired together. And then when you go in here, they offer two different products on each asset. So first of all, it has a period of time in which it's locked up. And so, I mean, in a way, maybe you could kind of think of these similar to ETFs. Like these are being managed in a way that, is to produce a particular result. But anyways, you lock it up for a period of time. You put your deposit in, you deposit to one side or the other. And then your funds are locked up, and then the contract, whoever's managing it executes a particular strategy to get the results. And I believe it's a contract in this case. So it's utilizing other DeFi protocols. There's not one person that has access to these funds. It's putting them to work in other ways that yield, bear a particular yield return. So that's the gist of it. And it, so at a higher level, they have this yield bearing position, and the risk off investors make their deposits into what will be a fixed yield result. And so on that markets page, the fixed side is you are guaranteed that return. And then on the variable side, there is nothing guaranteed. It could blow up, and we'll look at a couple historical numbers, or it could blow up. It could blow up good. It could blow up bad. The variable yield side would be the leverage side of this equation. And so you can kind of see in this picture here, the way they achieve that is at the underlying, they're utilizing a real yield product that has a fixed return result. And that's how they get their fixed yield, because it will bear a 10% yield. And then the people that deposit into the risk side, they will use that risk deposit as collateral to the risk off investors to then go leverage and try to make a higher yield on the variable side. And so we can see in historical performance here, looking at the USDC pair, we can see on the left side, this APR, this would be the fixed side. So every tranche, 9%, 9%, 9%, 10%. And even though this is variable here, it's fixed in that it's advertised before it closes. You know exactly what the fixed side is going to be. And why that's variable depends on, again, that underlying yield that they're using. That might change from month to month. And then on the risky side, risk on, we have, oh, cool, 32%, 23%. Uh-oh, minus 23%. No one told me you could lose money in crypto. Minus 45%, minus 51%. So you can see that the variable side varies widely. And, even in a minus 50%, the fixed side got their fixed 12.5%. And that's, again, because the variable side was leveraged against as collateral to the fixed side. And so that was, there was probably in this period of time, July to September. I think we kind of looked at a chart about that as to what was happening in the market in that particular time frame. So the variable yield was not well performing. So anyways, so to my positions that I had on, what did I do? So again, for reasons that don't really matter. I wasn't able to deposit. So I had $100 that I brought to this experiment. I decided, because Bitcoin was the topic of the first two trades, I was like, let me jump into Bitcoin here. But I thought it might be interesting. Like, instead of doing the Bitcoin pairing, I was like, well, what if we try to be more risk averse or risk mitigated, and let me do a half and half. So let me do the Bitcoin USDC pair, and let me split it 50-50, put $50 on the fixed APR Bitcoin and on the variable USDC. And so I wasn't able to get the $50 in the same exact tranche, again, for reasons that can be discussed in a different episode. But if we take a look at what ended up happening here, on my variable side, I had $50 that I deposited here, and we can see that my realized return was $1.99, and that was a 2-month period that $50 was locked up and it was used. And again, this is the variable side, so it was used as collateral to the fixed side to be leveraged, and it ended up coming out positive at $1.99. So not too shabby, but risk on that half. The reason I went risk on the variable side with USDC is that underlying asset is $1. So that underlying asset is not subject to its own fluctuations in value. So curious if that helped in this result at all, because as we can see in my other position where I put $50 worth of Bitcoin on the fixed yield side, I got my fixed yield. So you can see, and this actually comes off in 3 days. So by the time this airs, it will be off. But my fixed yield was 10%. So when this comes off in 3 days, I will have 0.000025 Bitcoin waiting for me to claim. So hooray, I got my 10%. But also, if we remember the Bitcoin chart, it is a wildly variable asset with great price fluctuations. So I got 10% of the Bitcoin that I put in. It just so happens the Bitcoin itself is also down 13%. So I'm down on the position, but I, got that 10% yield out of it. So I don't know if there's much to draw from this other than it did the thing I expected it to do, which was it proved that stablecoin yields can be decent. Again, I was on the variable side, so that very easily could have been negative. But on the fixed side, it's also not a terrible yield over there. But more than anything, I guess what I wanted the experiment to show was just, again, I guess I kind of come back to that capital efficiency. And to somebody who doesn't know the crypto world, this is all hogwash and voodoo hoodoo and whatever. But again, that's part of the journey of like understanding where is that yield coming from, and understanding those mechanics at play that, is where I still feel comfortable saying it was capital efficiency, not saying it's, the first thing you go to, because this was $100. Like, it was not a significant portion of my overall portfolio, as so it goes in the world of crypto and portion sizing and all that sort of thing. But I thought it was interesting. Hopefully somewhat understandable, but probably confusing, and you can just focus on the first two, I guess.
Now, like I mentioned, we lost a significant chunk of the audio. However, there is one important point that I had called out in the show with respect to this last strategy of the yields on the particular underlying asset of, in this case, Bitcoin. It's important to remember that it really depends on your strategy as far as how valuable this results actually are. What I wanted to call out here was, if you are long-term bullish on Bitcoin in general, you have to remember then that you can't think of this in terms of USD. because you are accumulating that percentage of Bitcoin. Yes, Bitcoin value went down. However, you got that return in Bitcoin. And so if you are bullish on the long term, then it really doesn't matter that Bitcoin was a little bit less than, because if your goal is to accumulate the asset, this is giving you that percentage yield in that asset. And it's only when you start thinking that in terms of USD that you start saying, oh my gosh, this was a big loss, or it was more of a loss than I thought. But if you really kind of separate yourself from, I am not trading this with respect to the US dollar, I'm trading this with respect to itself, and I want to accumulate more of this token of Bitcoin in this case, then, you might view the output of these results differently.
Yeah. Yeah, I think that's fair and really important to anybody that's thinking about getting this deep into crypto. Obviously there's trading on an exchange and all that sort of thing, but yeah, if what you want is this long-term accumulation plan, that's definitely important to call out here. And if you were this deep and you really cared about that US dollar value, then that's the USDC half. Stay on that stable coin that's pegged to $1, because that's the denomination you care about. So yeah, certainly don't go to another denomination of bill and think that it's going to have this magical correlation to the USD value that you started with.
Now, that is the end of the audio and video footage that we were able to salvage out of this week's episode. Kind of disappointed about that. I'm not really sure what happened. I thought I was watching the meters and everything as we were recording, but I guess those of you that have ever done a recording or a show or a podcast, this stuff is bound to happen. I will have to kind of reflect back and try a better job next time so as not to lose so much content. I will be re-recording pieces of that in the future upcoming episodes, because I do think there were some valuable points to bring out of there, and you will find those first two topic updates covered in a future episode. Hopefully your trading week pans out better than this recording week. And I hope the next recording week is better than this past recording week, because that really stunk. Anyway, lots happening in the market where really traders are coming back from their summer vacation. We're getting into the fall time. September and October are very historically volatile months within the markets. So we'll see what happens out there. Good luck to you. I hope you guys find something you're interested in trading. And remember, think outside the block.